Well, if you didn't think ADP could do any worse, well, maybe you didn't see today's headlines, because what we're going to go over today is right through here. ADP reports labor market growth slows dramatically in the U.S. in August, adding just 54,000 jobs. Why this might be good news, bad news, or how did the market react to this? Well, that's what we're going to talk about in today's video, folks. So my name is Dan Frio. I come out each day to explain to you guys, or help you explain, what's going on with those and the whys behind it. Because if you're watching this video, most likely you're looking to buy or refinance. So let's get to today's news. So here's how we started the day. ADP came out and they said the jobs report number was pretty bad. Well, let's kind of take that with a grain of salt. We got to go over and show you their numbers historically, but where I want to really take you is, here's how the market reacted. We basically have a Cinderella story across the board, and this is what I call a Cinderella story, folks. We got the Dow Jones, the S&P, the NASDAQ, and the Russell 2K all up. Okay, so if you have money in the market, you probably made some money today. The VIX, this is basically the anxiety level on Wall Street. That's down 4%, down to 15. That's a great number when it comes to the VIX. Let's get over to see what oil did for the day. Folks, we can't have any better unless crypto did good. Crypto lost it for us for the day. So we got great news on oil, but if you have any crypto, you lost a little bit of money there today. But here's where the news comes in. I want to take you over to Rick Santelli. Now, this was the breaking news this morning. And why this is important, well, he goes through the ADP payroll numbers, and I think he kind of washes those by, kind of like I think everybody else is doing right now, and he dives into a lot of the other numbers. After watching this, you let me know if you think the markets are ready to crash, the jobs markets are going to crash. And I'm going to show you what the forecasts are for tomorrow, because we have the unemployment rate, the true unemployment rate coming from the government tomorrow. Is it true? Well, we're going to have to go with it. Yes, we also created our own model on AI. I'm going to show you that as well. But let's first go over to Rick Santelli. Let's see what he has to tell us for the day. It was a good day in the stocks. Let's see how it was for bonds. And then when you come back, I'm going to show you really what happened to bonds, mortgage rates, and then we're looking at for tomorrow's news. So take it away, Rick.
Rick Santelli here live at CME HQ with the breaking news of the morning. Second quarter final read on non-farm productivity. It jumps to 3.3%. This was with expectations well under 3%. Our last look at 2.4. 3.3% would be the best going all the way back to the last quarter of 23. That is very good news. Unit labor costs moderate from 1.2 expected, 1.6 in the rearview mirror, goes down to 1%, That would be the smallest since it was negative minus 1.5 in the third quarter of 24. Initial jobless claims, 237,000. That's up 8,000 from a non-revised 229,000. 237,000 would be equal to the second to the last week in June. To find a higher one, you're going to mid-June at 246,000. We have not been above 250,000 since October of last year. Continuing claims, a bit lower, 1,940,000, but still a string of 1.9 millions. Last month, slightly revised. These numbers all comp back basically to they comp back roughly to 2021. We're looking at November. Now, the trade deficit, we know that this, of course, has been a bit crazy due to some of the issues with tariffs. Comes in at minus 78 billion, roughly as expected. The rearview mirror is minus 59 billion. And if we look at what has happened in the market since all this data is released, prior to the number, we were around 418 in a 10-year. Right now, we're at 419. That's down 3 basis points. And as far as summarizing the data, initial claims still remain well behaved, even though they've crept up a little bit. Above 250, in my opinion, would strike some greater scrutiny in this regard. Productivity is a win no matter how you look at it. And our last guest regarding ADP, Nella Richardson, brought up an important point regarding the work week. But I'm not sure how ADP fares, but I could tell you.
I'll leave it at that because he kind of rants and raves about them as well. So that's the news that the markets took in today. So here's what happened. The bond market took that in stride. They're like, okay, we got a weak job market. And I'm going to show you our forecast here in a second, but it's not falling off a cliff, which is Great news. So this is great news for bonds. So you're seeing a nice little rally in bonds today. So that's bringing down rates a little bit. But again, what I want you guys to look at is right through here. If you locked in, let's say we locked in a lot of people at 6.499, 6.5. Okay, you have to wait till it's at 6.375 until there's really an adjustment in the rate, because rates go in eighths. So that's where it is in through here and so forth. So really rates aren't, you can't get a rate at 5.81 normally. It'd be 5.75, 5.875, and so forth. So that's what we have so far in that piece of the market in regards to interest rates. Now let's get over to the economic calendar. Now here's an important thing that's coming in tomorrow, but here's what I want to show you. Some numbers that we got today that Rick just went over. The ADP payroll numbers. Now here's where I say, can they get any worse? Okay, so when I go through here, let's look at the historic numbers with ADP. Okay, so I think I did this morning, but this is basically what their forecasts were from March up through this last reading. So the reading right through here, in March, they came in and said there should be about 141,000 new jobs created. There were 77,000, so half. It doesn't get any better than that, folks. You go up to here, 114, it came in at 62. 99,000, it came in at negative 33. So I throw this out with the bathwater. So what we're really focusing in on now for today was the initial jobless claims that basically came kind of in on point. And then the continued jobless claims, like Rick Santelli. This basically went below what was expected. It was expected at 1.96. Okay, and he also said right at the end there, we don't want this going over 250, the initial jobless claims, because then it can't get absorbed. Then you're going to have, the jobless numbers keep compiling off of that. So then what do we got coming in tomorrow? So here's the biggest news that we have coming out tomorrow. And this is where I wanted to do some, AI data. So we're filling in some AI to kind of help predict what our forecasts are going to be with the unemployment rate for tomorrow, because that's a big to-do when it comes to interest rates, because the Federal Reserve, what do they monitor? Well, they monitor the jobs numbers, and they also monitor inflation. Okay, so the unemployment number is one of the numbers that they monitor. Okay, so what we're trying to figure out is tomorrow what we're going to get. We're going to get average hourly earnings year over year, same thing month over month. What they're saying here is if you stayed on your job, you got about a 4% increase year over year. With inflation at 3%, well, at least you're keeping up with inflation. Non-farm payroll, that's another piece. That's mainly what we're looking at. What's the payroll number going to come in? And then where's that going to put the unemployment rate? Right down through here. So what's expected here is the unemployment rate previously was 4.2. Now it's moved, they're saying it's going to move up to 4.3. This has been gradually moving since the beginning of the year from 4 to 4.1. Now it might be up to 4.3. So I wanted to do some analysis because I don't like just taking this for face value, because if you do the ADP payroll numbers, we could probably do better than this. So when I said, okay, let's go over to AI and just figure out what the unemployment rate should be or could possibly be based on all the data that we can feed it and we can upload into the system. So here's what the system did. This took about a half hour for it to run, and I was surprised it took that long. So here's what the system is telling us based on all the data I was able to upload, giving it financial reports, financial websites, and so forth. So here's what it's expected tomorrow. When the market comes out tomorrow, I won't be in the opening bell, I'll be on the flight back to Chicago, but I will have a midday report where I'm going to go over where the market did with a lot of the data that's coming in. Then I'll give you my, we'll conclude what happened for the week, and then I'll give you my weekly forecast, what I'm expecting for next week. But here's what the system's telling us. They're saying the unemployment rate snapshot. The previous number was 4.2, and we'll validate that on the economic calendar. The consensus vote on Bloomberg was 4.3 is what the unemployment rate would increase to. Main Street is saying it's going to come in at 4.2. With all the data we provided it, and there's slews of analytics and all kind of stuff up through here. Here's what it's telling us. It's basically coming in and saying, well, the unemployment rate's going to go to 4.3. So now before you freak out, let's look at the data to see is 4.3 historically. Is 4.3 historically good or bad? Well, let's dive down through here. Is 4.3 concerning? Well, historically context, the U.S. has averaged 5 to 6% unemployment over the long run since World War II. Okay, so that's a long time. Anything under 5% is basically or typically considered full employment. So that's what we're going to have. So the Fed's job is to keep inflation in check and to keep the markets or the jobs numbers at full employment. Well, 4.3 is still full employment. Okay, the Fed's view, that's a whole bunch of data there. At 4.3, we're right in the sweet spot, basically is what that's telling us through here. We're right in the sweet spot of full employment. Should it be alarming? Nope, not alarming at all. It shows labor market is cooling modestly, but not collapsing. Bottom line, a 4.3 unemployment rate is not concerning. It consists with the full employment. It signals a softening labor market compared to the ultra tight conditions of 2022 and 2023, but it remains healthy. So basically that's what it's telling us. It's saying the jobs market is remaining healthy, but when you get these reports from ADP like this, it's like, oh my God, the market is collapsing. So that's why the markets, they ended up, and the market's still open right now, but we have MBSs, they're up 15 ticks. So that means mortgage rates are come down, just a little bit more. But if you're locked in again at 6.5, got to wait for this to go to 6.375 to reach back out to us. But if let's say, for example, you're at 7.5%, what should you do now? I'm going to give you my insight on that here in a second, because my name is Dan Frio. I do this report each day to help you understand what's going on with these and the whys. And I have a slogan. My slogan is one application, one credit pool, and we're going to compare your loan to over 30 different lenders. How do we do that? I'll get to that in one more second. I want to show you one more piece of the puzzle that I want to go over for today. The earnings reports. Now, I like to go over through earnings reports for you when there is some earnings for the week, because I want to show you our companies, how are their earnings doing? How's their revenues per share? How's all that looking in the rearview mirror? So each week, I'm going to come and show you how earnings reports are coming in. So right now, here's what we have for the week. And Wednesday, this was probably the biggest week, and that's why I'm showing this to you right now. So I'm going to click on Wednesday and to see how the earnings report came in. So all you need to do is right over my head, you're going to see where it says revenue. So all of them beat on revenue except one. A couple didn't even show, but maybe I don't know why there. But the majority of them beat on earnings or revenue, and then earnings per share. Well, every one of them beat on earnings per share except one of them. So that's telling us companies are still hitting their earnings estimates. They're not actually coming in way below forecast, and that's going to keep up the earnings, which is actually going to keep up the markets in general when you talk stocks, bonds, and so forth. So that's what's happening. Now let's get over to me, who I am and what do I do. So like I said, my name is Dan Frio. I'd love to be able to work with you if you're looking to buy or refinance your home. I've been doing this for over 35 years. Put my 35 years of experience to work for you. Okay, I work at a federal bank, and that means I'm licensed in all 50 states as well as Puerto Rico. So if you're out there anywhere in the United States, want to work with me, love to help. So here's also what's intriguing. You've been taught over the years, get 2, 3, 4, maybe 5 different quotes to make sure you're getting the lowest fees and the lowest rates. Well, I wonder if you can do that with one place, one application, one credit pool. We're going to compare your loan over 30 different lenders. That's what we do here at the bank. So how you do this is put in your application right through here. We're going to pull your credit and we're going to get you approved. Now, here's where the hard work starts. We're going to start comparing your loan to over 30 different lenders. These are banks, credit unions, and even just mortgage lenders that we're associated with. We can use their programs and their products. So you can use me during this whole process. How do you get involved? Go to therateupdate.com, folks. This is how you get involved. If you're looking to buy a house, please stop right here, scroll down, and hit this button right through here. This is going over a grant with you. The nice thing about this grant, you don't have to pay it back. Okay, it's up to $7,000. And why this helps you is a lot of people that are looking to refinance right now, they're getting stuck not being able to refinance. Why? Well, they got a down payment assistance program that wasn't forgivable. So now they have that $10,000, $15,000, $20,000 extra that they owe on the house. House isn't worth it. And you add another $20,000 to your payment. Even if you bring down your interest rate, your payment's going to go up. So that's how you avoid these things. But getting a down payment assistance loan, you don't have to pay back. If you're looking to refinance and you're just like, Dan, I keep missing the rates. I don't even know what rate makes sense for me. Well, do me a favor. Just plug in right through here, the refinance. You're going to click that. Let me know what your interest rate is. And just let me know what interest rate you want me to reach out to you when it hits. Let's say you're at 7.5 right now. And you're like, Dan, when it hits 6.5, call me. Well, you missed it. Let's say you're at 7.25 and you're like, Dan, when it hits 6.25, call me. Well, that might be a little bit better. So what you're going to do is you're going to put in that information in here. So when the rates hit 6.25, I'm going to reach out to you. What I'm going to do is say, here's what the rate is. Here's what the payment is. Here's what the costs are. Here's your break-even point. Does it make sense? Yeah? Well, let's get you locked in and started. It doesn't make sense? Well, let's just wait for rates to drop a little bit lower. So that's what we can do here. And we can also do one more thing. Let's say you already got a whole bunch of quotes and now you're like, Dan, how do I can you compare my best quote with all the lenders you have? Well, do me a favor. Just go to the loan estimate review tab. You're going to upload your loan estimate right through here. We need at least 30 days or more for closing. But if we can beat your current lender with rate and fees, I'm expecting to win you as a customer. So that's our report for today. And a reminder, folks, I won't be back here tomorrow morning. I'll be back here later tomorrow afternoon to give you how the markets are reacting to the jobs numbers that come out tomorrow. And then I'll give you my forecast with look for next week. So thanks for watching. If you need some assistance, please reach out to us. We'd love to help. Other than that, God bless. Have a fantastic evening. See you tomorrow. Bye-bye.